Christopher Nicholson, Managing Director of ACF Equity Research, and his colleague Renas Sidahmed will present recently published research on the rare earth sector, providing investors with a deeper understanding of the macro drivers for commodity prices and the competitive landscape in which the rare earth metals sector operates. Christopher has been a financial analyst for over 2 decades and trained at global US-based fund manager Legg Mason. He founded ACF Equity Research over 10 years ago, and Renas worked at both the IMF and the World Bank, as well as Mitsubishi Securities in London, and she's now Head of ESG at ACF. Both are much sought after commentators, so we're very pleased to have them. Welcome, Christopher and Renas. Welcome.
Thank you very much indeed. Thank you. Ladies and gentlemen, we are delighted to have been invited this evening. 2 very good presentations running before us, we hope we can do the evening justice as well. So I hope that you can see our first slide, which is our introductory slide. Is that all clear? Can that be seen?
Christopher, we certainly can.
Okay, super. We're going to talk about rare earths as a sort of thematic piece, and then my colleague Renas is going to give you some insights into some of the challenges of modeling rare earths companies and some of the operational challenges that they also face. I think they probably won't be the usual things, so hopefully you will find it all very helpful. Just a couple of lines really on ACF. We are an independent research house, and our audience or our clients are the corporates. We keep it very, very independent by asking them to pay cleared funds up front for the year, and we always decline to publish only 1 note, so it's about 7 notes a year, so that investors are kept up to date. So if I go to the first slide, just a bit on us to give you context. This slide here shows the kind of portfolio managers that use our research and read it. So at the top, you've got companies with trillions and billions of dollars under management, and in the bottom row, you've got examples of companies that perhaps have 10, 20, 30, 40, 50 million dollars under management. And this is where our corporate clients are listed. So we have clients listed in all of these main markets here. So you've got North America, Europe, UK, Southern Africa, and Australia. And then we do consider ourselves to be a global company, taking advantage of the UK time zone, and our clients certainly consider themselves to be global. This is where they do their business. So they're everywhere, essentially, except for China and Russia, for obvious reasons. And then just very quickly, in terms of our distribution, 99% of all professional fund management terminals have access to our research. Bloomberg alone would give us 30 million plus potential eyeballs per annum across both their retail offering, which is their website, and across their institutional platform. And that's just one of many distribution channels that we have. So today's agenda, we're going to give an overview of REEs from a sort of thematic research point of view. We'll take a little bit of a look at peer and valuation multiples approaches, and then the link between REEs and ESG, at which point I'm going to hand over to my colleague Renas, as I'm sure you'll have heard enough of me by then, and she's going to talk about ESG valuation considerations and give you some insight tips on the challenges associated with modeling REE companies, which are quite specific, and the challenges and a couple of insights, I believe, Renas, and the challenges of RE mining in practice. Right, okay, so let me kick off with my piece. I will just share a little slide with you, which gives you a little bit of context. So the first thing to note is that rare earths, in spite of them, are not rare. There's a lot of them, 17 in total in the periodic table, and they have a relatively high crustal abundance at about 130 to 240 micrograms a gram. The issue is that economic concentrations in the context of contemporary mining technology are rare. And so this slide just shows you very briefly how rare they actually are. So the green elements are, if you like, exploration areas, and the red elements are production areas. You can see that there's not much outside of China and southern India, essentially. So the principal mined RE minerals, just as an overview, are bastnasite, monazite, and loperite. And then the softer mineral is the iron absorption clays, which are dominant in southern China. And also there are one or two spots for iron absorption clays in Uganda in Africa. And Renas may mention those as examples, for example. So then the principle, or I should say that rare earths are absolutely critical to the energy transition through their use in permanent magnets. So this is the key reason why they are worth studying, and it's worth looking at the companies that are attempting to extract, process, discover, etc. Permanent magnets, just by way of an overview, are transform mechanical energy into electrical energy. They are used in items including wind turbine generators, EV motors, etc., solar panels to some extent. And in terms of the actual permanent magnets, there are already four rare earths that are important. So neodymium, praseodymium, dysprosium, and terbium. I always struggle with the pronunciation, so apologies there. And included in the sort of production of permanent magnets, you also get some iron and some boron. So you may have heard of neodymium iron boron magnets, and you may have seen the abbreviation NDFEB, which refers to the same thing. So let's just get a handle on how important the market is. So in 2020, the RE market was valued at $2.6 billion approximately. We expect that to nearly triple by 2030. Permanent magnets account for 43% of RE consumption. And permanent magnets account for 90% of the global market value of the RE market. And China produces 90% of permanent magnets. So the slide here just gives you a little bit more color in terms of the, if you like, the use, if you want, by mass or by volume of REs. You can see there 43% for magnets. Catalysts are the next biggest usage at 17%, and then you've got metallurgy and glass polishing, etc., and battery alloys. So they are actually used in batteries as well to some extent. China and India dominate RE, what we call refined supply. So China controls close to 85% of global RE refined production, and this controlling percentage has continued to expand. India is a player too, and by contrast, India, as an aside, it holds about the world's 5th largest reserves of REs. So Chinese RE market dominance is a global strategic concern. And because REs are essential materials for electric cars, defense applications, and net zero electricity generation via, for example, wind turbines, governments such as the EU, US, Australia, and sectors such as autos are investing significantly in vertical integration, i.e. their own capacity, so their own supply chains. We predicted about 3 years ago in our global series of one-to-one briefings for the CXO suite of a large number of mining companies that in the future of mining companies would become vertically integrated. At that time, there were very, very few examples of this, but 3 years on, that concept has been thought of internally by other companies. I'm not suggesting that we gave them the idea at all, but it has come about that this is now a much more common idea, and there are examples springing up everywhere of vertical integration in mining. I mean, one of our ideas was that in the end, miners may never actually sell REs. They may only loan, lease, or rent them. That is material for a different presentation, of course, but it's an interesting idea. So we just touched a little bit on mine supply. So China currently dominates RE mine supply as well. Although we believe that China's dominance remains of critical concern, we also believe it is decreasing. So China's share of production of REs was estimated at about 57% in 2020. So this is digging it up from the mine. This is not actually processing it into a useful metal or a permanent magnet. Yeah, so we believe that production was estimated at about 57% in 2020, and that's down from 81% in 2016, which is a fall of about 4.6 percentage points per annum. And if you were to extend that decline rate between 2021 and 2023, that would bring Chinese mine supply, so the raw material, digging it up, below 44% of the global total. So this actually seems unlikely to be the actual case. But if it is, it may go some way to explain RE pricing behavior. It does appear, nevertheless, that China is heading for a significantly less dominant mine supply position. And we forecast that China's share of mine supply will have fallen below 50%, not below 44, but below 50% in 2022A, or once the data comes through. The caveat to all of this, of course, is that China can raise production volumes by 20% in a year simply by readjusting internal policy. So that does make forecasting very, very difficult, and it does mean you can see distortions which might throw one off track. But overall, we stick by the view that their dominance of the mine supply is decreasing. So let's just take a very quick look at demand. So Global Data, a research firm, predicts that global rare earth demand will reach 193,000 metric tons by the end of 23 and continue to grow at around about 4% CAGR between now and 2030. We, on the other hand, expect the demand to grow faster in the next decade, driven by clean energy applications where REEs are critical components. We anticipate that many products using REE will reach growth inflection points, e.g. EV adoption, electric vehicles, wind energy, etc. In our base case scenario, we expect demand growth of around 7% CAGR until about 2030 to around 270,000 metric tons, up from approximately 167,000 metric tons in 2020A, and that number's according to Arafura Resources. So I hope that gives you a very brief overview of the sort of thematic nature of the sector. We have a recent thematic research report available on that, which we were happy to send to you if you want to subscribe to the site and just make a request in your email that you particularly want the REE report. Peer and valuation multiples. Let's have a quick look at this. In our rare earth peers, we use a mixture of companies. So we use both those that are still at the exploration stage, so they could be pre-strike, or they could have discovered something, but they don't have revenues. And we also look at companies that are revenue generating. Our focus is on companies that are involved in product or exploration for RE metals that would be used in permanent magnets, because it's 90% of the value of the market. And some of our peers, like Lynas Rare Earths, they are revenue generating, and then some of them are non-revenue generating, like IXR and Rainbow Rare Earths, which are in the exploration and development phase. And we also choose differences in scale as well, and we combine those and take a look at things. So one of the techniques that we use, it's not the only technique, but it is an important one, is that we compare the peers using multiples based on the potential resource expectations of MI plus I, so measured, indicated, and inferred. We then analyze the company's enterprise value. That has to be done specifically because there are different ways of treating debt, and it depends on the instruments and how they've raised money. But when we get the enterprise value, we then look at what the market gives to the value via the market cap. And then we compare those valuations on the basis of ton of resource and get a dollar value. And by looking at the two approaches closely, along with the other things that we do in valuation, we hope to determine which companies are potentially overvalued or undervalued by the market. In other words, what is the market misunderstanding? In many cases, and particularly for non-revenue generating explorers, there is a lot the market doesn't understand. The same is coincidentally true for biotechs, if you happen to also like biotech investment. Now, the thing to remind yourself of is that when the market doesn't understand, it considers that a risk. And markets downgrade the company and the sector valuations a lot more than they generally deserve. So the market effectively overshoots its markdown, exactly as it should if there is not enough clear, digestible information. it interprets this information asymmetry as a high degree of uncertainty, and markets particularly dislike uncertainty. Recalling that a miss is always punished more than a beat is rewarded. So rationally, the market overestimates the pain potential in the same way it underestimates the gain potential, except temporarily when the market suffers from FOMO, fear of missing out, where everybody gets extremely excited, and this leads to a pricing bubble, which generally bursts, well, always bursts, and that's generally a painful experience. So I hope that we've given you context of the valuation, and now we just tee up the link with Renas on the ESG side. One of the key longer-term advantages for RE, and it is absolutely integral and at the heart of the drive, the so-called zero carbon emissions strategy globally, which in turn is intimately linked to our thoughts on sustainability, ESG, and valuation. Renas, over to you.
Thank you very much, Christopher. Good evening, everyone. Right, so the ESG valuation consideration. The reason for having an ESG policy, preferably with metrics, is not just about the regulations. Although regulation is now catching up to with capital markets. So by 2027, the UK, EU, and US will make ESG reporting a requirement for both small and large companies. However, in our view, having an ESG policy can de-risk a company by lowering its risk elements, which in turn lowers the overall cost of capital, which then influences the DCF value, and ultimately can improve a company's valuation. This is ever more so important for companies that are involved in brown assets or mining, if they want access to investor capital at scale and or reliably. But it's also important because the many so-called responsible investors tend to steer away from mining companies because they're not actually aware of how mining and ESG can go hand in hand. So we have seen this personally, that mining and ESG can go hand in hand. For example, Kibo Energy, which is dual listed in London and Johannesburg, is shifting from brown assets into renewables by way of waste to energy. And then you have Ionic Rare Earths, which is listed in Australia. It's a rare earth mining company that is moving into magnet recycling space to create a circular economy. So now I'm going to move on to some of the challenges associated with modeling REE companies. I'll provide a few inside tips or choices to be considered. So we know rare earths are a set of 17 elements. They're not traded on the open exchanges, so more commonly over the counter, and the prices are very different. But what this means in practice is that there is little transparent market pricing. So it's not like trading oil or foreign exchange. So when you're modeling an RE company, one challenge is how to factor in the price of these elements over time and efficiently. So you could attempt the basket route, excuse me. However, that can create inaccuracies with the valuation. Because although there are different basket weights for each element, as I've mentioned, the prices do vary significantly. So instead, you would want to price each of the elements individually for each year of the model, i.e. the life of mine. This can be very time consuming. Believe me, I know I've just actually come out of modeling a rare earth company, but in doing so, you can avoid over or undervaluing the company significantly. It also means that the integral structure of your model is better because it is more flexible. Another challenge with modeling RE companies is deciding what to include or not include in the valuation. So in terms of an REE company, I'm referring to the actual MRE, the mineral resource estimate versus the potential MRE. And there's two scenarios. First one is, do you want to be overly conservative? In that case, the company is more likely to beat your expectations, and that will leave a lot of value on the table. The other scenario is, do you want to be more aggressive? But then in that case, you have to explain why the company failed to meet its targets, why you said they would, and then in the end, everyone ends up looking bad. For me, as an analyst, I prefer to err on the side of caution. As we know, explorers are a zero-sum game. And until we physically see what comes out of the ground, we won't actually know what's there. So I'm going to move on to the last topic, which is challenges of REE mining. So a particularly tricky issue when analyzing REE is supply chain vulnerabilities, which are driven by several different factors. I'll come to those in a minute, but I just want to remind you that all sectors obviously have their own peculiar challenges when it comes to investing. But I can say that with mining, it is one of the sectors with extraordinary upside potential for explorers. But again, it is a zero-sum game. So factor number one, geopolitical concentration. So southern China and Myanmar mine approximately 98% of the global supply of REEs. China also has adopted a comprehensive set of policies that could limit supply growth. It is also busy navigating its relationship with the US and other democracies. So you've got single party or single ruler states tend to be somewhat more unpredictable in their decision making than democracies do. Factor number two, economic viability. The RE market is relatively small and volatile compared to other metal markets, so that can lead to fluctuating prices and price manipulation. So if you can manipulate the copper price, which is a relatively liquid market compared to many minerals, the potential for REE price manipulation in a highly opaque over-the-counter market is that much higher. And finally, factor number three, you have supply-demand equation. So for mining stocks, that can lead to prolonged periods of supernormal profits for investors and miners. It takes about 17 years from mineral resource discovery to mine production. However, technology is rapidly advancing, and the science of geology continues to get more effective. And like with many things, supercomputing and AI is going to drive that even faster. But the real lag comes from the rate at which policymakers are able to grant licenses. So I hope that AI will do a lot to speed that up, and of course, in a way that's safe for the environment. So in my view, we actually can have both. We can have shorter development timelines combined with much safer and more sustainable outcomes for the environment and the people working in the industry. And by that, I mean not just for the plants, the animals, and people on the ground, or indeed under it, but what manager wants to be all over social media for eternity because of an avoidable environmental or social catastrophe? Thank you.
Okay, Renas, that was brilliant. Thank you so much indeed. And Christopher, so you're both there for the Q&A?
Indeed.
Yes.
Who would like to take the first question? Shall we chuck this to you, Christopher? It's often said that lithium is the new gold, or indeed the new oil. I've used that line far too many times. I am a walking cliche. If so, where do rare metals actually fit in?
It's a great question. I'm slightly struggling with reigniting my video, so I'll just do that. I think it might be better. I think it's a very good question. You know, we talk to Western Australia chairman of mining companies, both on the lithium space and in other areas, and I think that, you know, where REE fits in, if lithium is the new oil, and I'm going to take that metaphor, is that basically, if you just have a storage system for potential energy, and you don't have any route to use the kinetic element of that to drive a motor, then all you really have is a bomb. So permanent magnets are the absolute linchpin to the value that is assigned to lithium as an energy storage component at any rate. And the reason why it's so important is because there are other competing solutions for utility scale long-term energy solutions, storage solutions, that can compete with lithium. And lithium is probably not the best solution for that anyway. But where it is a great solution is for transportation. So that oil analogy is a good one. But without REEs, or at least a substitute that would replace REEs somehow in permanent magnets, it doesn't have any value as a transportation energy supply.
Renas, your thoughts?
Well, I would have to agree with Christopher on that.
Very good. Okay, let me pitch this one to you then, Renas. You can have this one all to yourself. So you have first dibs at this one. From an investment perspective, what are the different ways in which you can invest in rare earth metals? And is now a reasonable entry point? Is now a good time to be looking at rare earths and investing?
So from an investment perspective, I would suggest raise some capital and actually go exploring, go and see what's out there. So look out for equities that don't have a China/Myanmar supply chain. So we're trying again. The Western world is also now trying to do that as well by creating their own supply chain. So you want to look for equities that are vertically integrated. So as Christopher mentioned earlier, the UK, Australia, US, as well as automakers are moving into vertical integration. And one idea that we have had for quite a while is that critical metals miners will, in the end, never sell their metals, but rather loan or lease them out.
Very good. And Christopher, where is the funding going to come from for all this this vertical integration and this, the supply chain extensions and so on and so forth? It all sounds great in theory, but it's going to take, what is it going to be? Private money? Is it going to be government money? Where is the funding going to come from?
Okay, so Donald, this is a very interesting area, and there are two aspects to this. You've got government backing will be important, because in democracies, if we are going to rearrange the supply chain and we're going to go down this vertically integrated route, China still has a very important trump card. It can switch on and off huge amounts of supply. It's probably got a lot of stockpiled material as well, which means that it can go in and flood the market and cause very damaging price changes from an investor point of view. It also scares investors, so it dries up future capital, which then delays plans, and it all becomes a negative reinforcing cycle. And of course, that could well be part of the, shall we say, toolbox that China has in order to look after its own interests, which one can understand rationally that it wants to do that. But overall, that could prevent public markets from providing the necessary capital that will be required, as you correctly point out. So there is an important role for governments to play in making sure that there is some stability for investors, especially in the early days. But on the other hand, what China has created through its strategy is a fantastic investment opportunity. It's essentially created from nowhere a market opportunity that didn't exist. And that is attractive to investors who like high risk, but it is also attractive to governments as well, for both political and geopolitical reasons, and because of the military applications of REE, there's that angle too. So yes, it requires government support, but we are seeing it. We are seeing policies in all the major economic blocs outside of China to try and develop these supply lines.
Yes, principally Australia and America, yeah?
Well, no, yes, I mean, that is very true. They, of course, are absolutely there, but the European Union has also really got stuck in here. I think that the ionic rare earths Belfast recycling plant is another example. I don't think that would have happened without European Union / UK commitment. The UK has signalled specifically that it would like its own critical metal supply chain on the island. So there are, I think, a lot of positive moves in those three regions. So the Australia region, North American region, and European region.
Do you have anything to add, Renas?
Well, in regards to funding, I just wanted to add that we touched upon the link between RE and ESG. So there is actually quite a significant amount of funding available globally. I mean, I think the number is about 2 or 2.5 trillion of ESG funds available to companies that obviously have an ESG policy or are on the ESG pathway.
That's a very good point, Renas. Okay, let me ask you the next question while we're with you. Are REE stocks mispriced today? And if so, why so?
So yes, fairly likely that is a yes. There is some market concern about upcoming substitute goods. So iron, cobalt, molybdenum alloys come to mind, but they are heavier. Others appear to be more rare than REEs or more expensive. and also the market is very excited about lithium, and given it is in the same ecosystem as REE, it is attracting some investor attention away from REE.
Okay, and Christopher, given the current very long timescales, you said 17 years. Does it really take 17 years from exploration to production? My goodness. Given the very long timescales for prospecting, can we expect a very tight supply schedule, that old supply-demand thing, and so a price spike in REEs can always be possible in the future? And of course, China turning on and off the tap and flooding the market.
Yes, I mean, this is part of what makes it an interesting dynamic, of course. And those dynamics also create enormous opportunities. I mean, the life of mine cycle is 17 years in a tier 1 jurisdiction. I mean, it can be longer in tier 1. This is, so you average that out. But really, the real sticking points for nowadays for life of mine cycles are not life of mine, sorry, for exploration through to production cycles, this 17-year sort of average. The real sticking points now, particularly in tier 1s, are the amount of time that it takes to issue the licenses. And so our view is the technology is moving forward all the time. Geology is improving greatly. I mean, we had a couple of examples hinting at that today in this webinar. But the other thing is that, as Renas pointed to, the AI combined with much more powerful computing has the ability to allow those issuing licenses to process information more reliably and quicker with better outcomes from an ESG sustainability point of view. And because it creates more transparency, it means that it's easier to manage investor expectations and management expectations. Managers will have to assume that the questions that perhaps didn't get asked in the past will be asked now, but both sides can prepare better and faster and more reliably. It's good for everybody. And in the end, ESG does reduce risk, so the returns are better for investors too. So you've got this possibility of contracting the mine cycle and having, at some levels, a less risky process. That leads to better returns.
Interesting answer. So, which takes us neatly to how central is REE to global sustainability? A big question.
Well, I would say it's extremely essential to global sustainability. I mean, without REEs, we would not be able to make the transition to net zero, as Christopher mentioned early on in his presentation. REEs are used in EVs; they're used in net zero electricity generation. So, unless we can come up with a substitute for REEs and their use in fighting climate change, I think at the moment there isn't a comparable alternative.
Okay, guys, we're not just out of time; we're spectacularly out of time. But how could I pull the plug on you? It's all absolutely such fascinating stuff. So, Renas, thank you so much for joining us. Christopher, thank you so much for joining us. That's the top team from ACF Equity Research. Thank you, thank you, thank you.